We have the man who a lot of people want to hear views about on all things possible in investing. Ridham Desai, Managing Director and Chief Equity Strategist India at Morgan Stanley, joins us right now. Well, on the eve, or rather, on the eve of your investor conference, and this is what, the 26th investor conference. Yeah, and we'll talk about that as well, Ridham. But can't not start off by talking about how do you gauge the landscape currently after what arguably seems to be policy continuity with all the major portfolios retained by the BJP and the markets celebrating it thus far, but the world markets maybe slightly skittish ahead of the FOMC. So perfect timing to have you. Good morning.
Yeah, good morning. Great to be here. It's a lovely studio. I'm really impressed.
Thank you.
And I'm so happy I made it here
instead
of interviewing in the Taj. I think there was a bit of nervousness on Tuesday afternoon because it seemed like we were going to have a little bit of a problem, but I think things shaped up well. I'm not surprised. I wrote a note overnight on Tuesday that this is continuity and just treated like a majority government. I have great confidence that this administration will basically continue the work of the last 10 years and actually accelerate things. So I think that's the message from the electorate. If there are multiple messages here. There are political messages, which we will not discuss because they're not relevant to the market. And then the economic message is that I think there are a few people that are still behind the poverty line. Obviously there are. The number has gone down by 10 points over the last 10 years, but there is still, maybe 15% of India that is below poverty line. And to lift them, and this is where I am counterintuitively suggesting to investors who concluded on Tuesday that we are now going to be back to populism. I think we're going to be exactly the opposite. In order to bring those people up, distributing cash doesn't work. Distributing cash has never made poor people rich. Okay? It may win you votes, but it doesn't make poor people rich. What makes poor people rich is you lift the growth rate and therefore create more opportunities. And the BJP-led NDA in the last 10 years, and I keep saying this, is that the Prime Minister is an inflation hawk. So that is what informs all policy making. So, the classic example of this is COVID. When the world was distributing cash, this government chose to distribute food because cash would leave an inflation imprint that will hurt later. And the FOMC context is precisely there, right? They're still struggling to get inflation back to where they want it to be. So that does not happen. And what happens instead is an endeavor to lift India's growth rate, because at 7%, X number of people get jobs. At 8%, that number goes up materially. So you lift India's growth rate, and at the same time, you don't let inflation pressures build. It's a very tight balancing act, but this is what I think the government is going to attempt to do. And then you just imagine how bullish that is for stocks.
Yeah.
Okay, that's Goldilocks multiplied by 5.
But just wondering though, one follow-up to that. Growth impulse from the government can come in via some fiscal measures, not necessarily reforms, because reforms in the near term, in the very short term, might actually not really lead to growth stimulus in the near term, right? So if indeed do you forecast or do you believe that there could be fiscal impulses given in order to boost growth? Because the consensus
Niraj,
is 6.5 to 7.
No, that's not the template. That template is not. Government spent during COVID because the private sector retracted. That is over now. The interim budget already told us that the government is stepping back. I don't expect any reversal in that thinking. Okay, that's exactly the point.
Right.
The template is for the government to step back and let the private sector crowd in. See, the private balance sheets are pristine right now, especially corporate balance sheets. 50% debt to equity. There's a lot of room to borrow, right? The government has been crowding out that because it had obviously judged that the private sector will be reluctant coming out of COVID. Now that heavy lifting is done. So the government is stepping back. India is the likely only large economy in the world, the top 15, 20 economies that could be in a primary balance in 3 years from now. And you have to understand the implications of a primary balance. So just for the audience, a primary balance is when you are not borrowing money to pay interest cost. The fiscal deficit is the total expenditure minus the total revenues. The primary balance or the primary deficit is what you have before you pay your interest cost. Now, at a corporate level, if you are borrowing to pay interest costs, you're bankrupt. Governments don't go bankrupt because they print money.
Correct.
Right? When you get into a primary balance, and given that nominal growth is 10-11%, you get a major deleveraging on government's balance sheet. And that has not happened in India's history. We've had 2 years in the last 75 odd years when India had a primary balance, but it was not by design. It was by luck of a very strong economy.
Which two years?
2007, 2008.
Okay.
So, I mean, 2007, fiscal F7 and F8.
F8.
You know what the markets did in those 2 years.
Yeah,
okay?
yeah. In the
Right?
midst of the
Yeah,
GFC.
so that is exactly what we are set up for in the next 3-4 years. So I think we go into a primary balance, it triggers a major re-leveraging of corporate balance sheets, and that's how growth gets lifted. This is benign for inflation because it's investment-led. See, look at the government's response yesterday. It was basically, let's build more homes. Investing your revenues does not trigger inflation. It's when you redistribute it. That's when you leave inflation impulses in the system, which then go out of control at beyond a certain time. So I think the impulse will be to trigger an investment cycle. And very 101 on economics is when the investment rate is rising, corporate profit share in GDP is rising. And there's a virtuous cycle. As profit share in GDP rises, corporate saving goes up and they invest more.
Right.
And all this continues until you reach a level where the incremental investments become unproductive. That will happen at one point in time in the cycle, but we're still not there. We're about halfway through the cycle.
Yeah.
So we have a long way to go before we get there. That's what happened in 2009-10. Investments became unproductive, and that's why the economy, and of course there were other things that happened because we let inflation out of control.
Yeah.
The fiscal and monetary stimulus was excessive. And I have this view that Manrega proved to be quite lethal because it fueled labor cost and did not have a corresponding investment around it. And that brought double-digit inflation and was the real foundational reason why the UPA lost elections in 2014, because poor people were impoverished. And even though we don't get annual data on poverty, I am sure that in 2014 poverty was at a multi-year high.
Right. Yeah.
Despite Manrega. Yeah. See, this is what redistribution.
In fact, you're saying because of Manrega.
Yeah, I'm saying because of Manrega. But it's not the single reason, because a lot of other things happened around that time. So I don't expect such policy responses.
Right.
I think especially foreign investors as a cohort, not individuals, misread India's politics quite a lot. And they don't understand. And look at yesterday's cabinet formation. Okay, continuity at an extreme level, which is essentially, it's almost like the Prime Minister is telling his cabinet, listen, your 2-month break is over, let's get back to work.
Yeah, exactly.
Yeah, so that's we're basically, it's business as usual.
Yeah.
So nobody has to learn anything new. I mean, there are a few moves, but nothing dramatic. So everything is as it was, and life goes on, and therefore they can press the pedal and move forward. Now, I know I'm not allowing you to ask any questions, but I'm anticipating your questions.
We're loving listening
There is
to
a
you.
50 basis points room that the government has earned in these 2 months since, or rather 4 months since the interim was announced, right? The base number is down 20. So instead of 5.8, it came at 5.6, and then the RBI has given a 30 basis points dividend check. So it'll be interesting to see what the government does with this 50. Okay, I don't think they will take the deficit down to 4.6 because I think that's too much of a contraction in a single year. The likelihood is that the deficit will be 5.1 and the remaining amount will be available for the government to spend. And I don't think that's priced into the market. That's a lot of money actually waiting to be spent.
In fact,
and that's good for liquidity, it's good for growth. It does set us up, and if the rain gods are, and I think my science tells me, and I disagree with climatologists that this was climate change. This was a ferocious El Nino which created this heat wave in India, and it is being followed by a equally strong La Nina. So come August, we're not going to be liking to come to office. Yeah. Because it's going to be raining a lot. So I'm expecting a very strong monsoon. Hopefully it's not, it doesn't cause damage, but it'll be a very strong rainfall, probably the best that we've had in a few years. So that sets us up for good farm output. The government has a little extra cash in its back pocket without compromising on the fisc. And I think, corporate sentiment should be good.
Right. Yeah. Can I come back to the private capex cycle? I think everything now seems to be still driven by the government's capex, Kitty. The private sector is not coming in a way that we need to scale up. See, for the next 5 years, if we have to scale up, now it's a question of scaling up. We can't just say that we'll do a bit here and a bit there. Do you think that private capex is coming in a way that can meet the ambitions that have been set for the next 5 or even 10 years?
Let me share the numbers with you. So the last time we had a capex cycle in the private sector was the period between 2004 and 2010.
Right.
Now the starting point in 2004 was 4% of GDP, which is corporate capex was 4% of GDP. GDP was a lot smaller then. It was almost 1/8 the current size. By 2010, that number went to 17. We had never witnessed such a capex cycle in our life. Okay, and Nifty earnings in the period between 04 and 08 compounded at about 30%. Okay, that's not our base case right now.
Yeah.
Okay, for a few reasons, I'll explain those. The private corporate capex cycle troughed at 4 in this cycle again. So from 17, it went all the way back down to 4 by 2020 second quarter, which was the end of during the first wave of COVID, and is now sitting at about 5. Okay, so it has inched higher. It is now off the lows. I think this 5 goes to 10. I don't think it's going back to 17. And there are reasons for this. One very important reason is India's ICOR has gone down. So let me explain that. ICOR stands for incremental capital output ratio.
Yeah.
Okay, that is the efficiency of capital that is available in the country. So our capital was a lot more inefficient 15 or 20 years ago. So for every dollar of growth, we needed $4 of capital, okay? And therefore you needed to invest that much more in order to generate a certain amount of growth rate. The second thing that has changed is the actual headline growth rate that the government is targeting. Now I have heard this multiple times from government, and I agree with them that India is just not ready for 9% growth. If you try to push 9% growth, then you will trigger inflation. And the growth cycle will end, like it did in that period.
Yeah.
Okay. Now at 9% growth with ICOR at 4, you need an investment rate of 36%. But at 7% growth and ICOR, which arguably is lower than 4 because India's capital efficiency has improved for many reasons. We can go into those details, but infrastructure, GST, financial system, digitalization, internet, broadband, everything has changed the incremental capital output ratio. The amount of capital I need is a lot lower, and hence I get more bang for the same dollar buck that I'm investing today than I got then. So if you are looking at that cycle and saying, oh, we're not yet there, we're not going to get there, and yet we will have robust growth rate. Now, if you decide that you want to push growth from 7 to 8,
yeah,
and your ICOR is say 3.8, you will need about 30% of GDP as capital, still a good 600 basis points lower than that time, and that is reflected in my forecast, which is we're not going back to 17, we're probably going to peak at 10.
Ridham, just on follow up on that CapEx question and some of the points that you've made. You're saying that no course correction will be required in policy. But I want to link a couple of things. Rural incomes not growing at the same pace, the question of unemployment, all of these came up politically and maybe got amplified for political reasons, but I'll leave that aside. The fact is that private capex is also waiting for consumption levels at bottom of the pyramid to grow to that extent. Every theme we talk about is premiumization. What push do you see to make that happen as well, where you have a more sort of secular growth rate?
You mean broad-based?
Broad-based.
Yeah. So let me admit one thing. I think coming out of COVID, we underestimated rural distress. Okay, so I was of the view that rural growth should have turned last year, but it didn't. And it has taken a little longer for the impulses from urban India to slip into rural India. So I think it is happening now, actually. So you can see that in corporate commentary, we have leading indicators which actually tell us that rural growth is improving. You can see it in the two-wheeler data, you can see it in what consumer staple companies reported last quarter.
Yeah.
It's finally turned. Okay, so that filtering of growth down has happened. The second thing which you must understand is that the government in the last 3 years during COVID has focused essentially on investments, and therefore the share of investments has risen in GDP. Okay, now GDP contains investment, consumption, and your external deficit. Okay, if the share of investments is going up and the external deficit has gone up down slightly, consumption cannot be at the same level, it has to lose share. So on a nominal growth basis, consumption growth has trailed investment growth. And that is how an investment cycle behaves. And that will continue to be the way it will happen over the next 4 or 5 years as the investment rate gains share. Unless you go into a current account surplus, which I don't think will happen. So we'll probably have a much narrower current account deficit. Consumption will lose a little bit of share, investments will gain. Then as the investment cycle matures and as things peak out there, that's when consumption comes back. So this is not the time when on a relative basis, again, and rural India reflects most, in the stock market parlance, it reflects into consumer staple stocks. They underperform in the 03-07 cycle. And their outperformance started in February 8. So from a stock market perspective, it's certainly not the place to be. You don't want to buy consumer staple stocks.
Yeah.
I mean, there may be pops and trading pops. And there was one last Tuesday because everybody thought populism is back, and it was a great moment to sell the stocks again and come back into industrials, which took a little bit of a backseat. But I think industrials and financials will lead the pack. Consumer staples will be trailing. So that's from a market perspective. But I think the rural economy is already improving at the margin.
No, so since we're talking about the market perspective, let me take that opportunity. Industrials you like, financials you like. You talked about government capex not being at the same levels, but what about your core sort of infra spends, railways, defense, make in India, all of that? You think continues at the same pace?
No,
Were you ever bullish on it?
No, make in India is not government spending.
PLI scheme, PLI scheme.
Yeah, okay, yeah, so I'll come to that. PLI continues, probably expands, gets even more refined, but the key infrastructure sector that I would be constructive on is railways.
Yeah.
Because that's where all the heavy lifting is now going to happen. The endeavor is to lower India's logistics cost maybe by 30-40% over the next 5 years. And therefore, the happy news here is that we have continuity in the railways. Because the outgoing minister and the incoming minister has already done a lot of work in the last 3 years. We wrote extensively about this about 6 weeks ago, about all the changes, and it's dramatic. I remember we had written a report in 2015. The average speed of a cargo train in India then was 20 kilometers an hour. You could cycle faster. Okay.
Yeah.
We've already come a long way from there. Okay. Now that speed has doubled, it will double again. So if the cargo, now think about the macro and the micro implications. If cargo on the trains is moving faster, it becomes cheaper to transport goods point to A to point B. Importantly, the inventory in the system goes down. Okay, so balance sheets become better. This is about ICOR. You need less capital to grow your business. So the implications in the next 4-5 years will unfold and surprise us to the upside.
Right.
So if there was one infrastructure sector where I think the government is going to lend greater attention to, I think it's railways. Now in the other sectors, I think the template has been set up, which is the gross spending will remain okay, but the net spending may actually decline because the government may actually start selling some of these assets more aggressively to fund incremental stuff. So everybody in the market, when they think privatization, they only think about government companies.
Yeah.
But you should be thinking government assets. They don't need to be corporatized in order to be sold. When you sell a road, you're still selling a government asset, you're still privatizing something, right? That activity, I think, will be very strong. And it will allow the government to fund the next road, it will allow the government to fund a host of rural roads that need to be built where you don't get the same economics or in fact zero economics compared to a highway. and the railways will get money out of the budget. So I think that's how I am thinking in a very big picture way.
Right, yeah.
Okay.
I have one question. To take this back to the market, when I'm saying market, I'm not talking about Nifty target or Sensex target. Today, the market that we are seeing is different from the market that we saw 5 years back. 5 years hence, you know, a large number of small cap companies, engineering companies, some of the older ones, they are all coming to the fore. So what I see today, the 1,000 basket, 1,000 stocks that I see could be different 5 years from now. So the market texture could change completely the way we are moving ahead.
Oh, you mean to say in terms of share of market cap of various
No,
companies?
not just market cap, in terms of mix of companies. You know, today a small cap company is getting so many orders, mid cap companies are getting so much orders. Now some of them would have grown so big if they are on this efficient path that we are looking at implementation and efficiency, right now. So they would look completely different. So forget the Nifty target or the Sensex target, that's par for course, you know, that math you've always been telling us. But the choice of stocks could be completely different if you look 5 years from now.
It's possible, but as such, the composition of the market in terms of sectors always changes from cycle to cycle. So it does not remain constant. So, you know, at the peak of this cycle, consumer staples will lose share. Financials and industrials will gain, discretionary consumption will gain, a few other sectors will lose share. And
Technology?
Then
as in IT?
Technology is, I think, very interesting.
Yeah.
So I tend to be quite bullish on some pockets on a 5-year basis. Cyclically, I am more constructive, but technology may not gain share, may quite lose share a bit at the peak.
Yeah.
At the peak. Okay. But it all depends. Then, of course, there are going to be a plethora of new listings. And I cannot really anticipate the sector diversity of the new listings, but we are going to get a very big primary cycle, very big one. In fact, it's just about to unfold in like the next 15 days. And a lot of companies will file to raise money, and therefore I think the markets will be less exuberant than they seem now, because the supply will come, and therefore it will become a more stock selective market. If I were to make a prediction by December, the Nifty will have, even before that, may have just exhausted for a while.
Okay. So, Ridham, a large primary market sucking out capital, but domestic staying true to the fore, and that capital likely continuing. Is that the base case? You made it a few years ago. It's panned out very well. Does it continue?
Yeah.
Part two of my question. What about the Goras?
See, the domestic investors are going to continue investing. Okay. Because of many changes that have been put into place. We created an acronym called DREAM, which stands for demographics, real rates, and policy changes and education. So a lot of things have changed. The household balance sheet accrues about $700 billion of saving at the current GDP rate. And if you look at last month's number, you're still annualizing at about 50-60 billion. So you've not even reached 10% of that number, right? The lowest amongst the developed world in terms of household saving into equities is Japan at 12. And Japan, by the way, is now back to equities. Okay, so they are coming back in a big way. European balance sheets have more than 50% in stocks. US balance sheets, household balance sheets have more than 40% in stocks. So we are nowhere close. So this has got many miles to travel. In fact, I am speculating that the government may even allow retirement funds to invest more. So today they are capped at 15% of incremental. The experience has been awesome in the last 9 years. This was allowed by the Prime Minister in 2015. So it's now been almost a decade. And I think the retirees are going to be quite happy because they're getting better and better returns even though interest rates are lower. The Provident Fund is able to deliver because of equity markets, and it makes sense for a long-term fund manager like the Provident Fund to be invested in equities. That's what happened in the US when President Reagan allowed 401k plans to invest in stocks. There it ended with the NASDAQ bubble in about 20 years. Here, I think it will run a little longer. Our people don't age like they did in America for a long time. So I dare say another 20, 30 years to go. So that's on domestic flows. Now see, in the market, and I say this and I get tired of saying this, there are only two cohorts, right? There are domestics and there are foreigners. If you look at last month's clip, they were putting about $200 million a day into the market. So imagine if domestic funds decide that they don't want to buy for 5 days. It's $1 billion now to invest. You don't do for 2 weeks and you have $2 billion, right? It's a lot of money. And therefore, they have to come every day to buy stocks. Somebody has to sell. So foreigners are selling. Yeah. Now this will change when the corporate issuers is in the game. So once primary issuances pick up, and therefore you now have the third cohort in the market and a fresh seller, you will find, ironically, the foreigner will come to buy. So if you ask me for a prediction, next 6 months, foreigners are going to buy India.
Okay, and I'm just tying this in because we have 5 minutes left with the investor conference.
I'll tell you one more thing.
Yeah, please, okay.
So yesterday, 3 days ago, somebody asked me this question, a client of ours, that, currently if you look at the emerging market funds, foreign investors are about 50 basis points underweight India. So India has a 17% index weight and foreign investments may be around 16, 16.5. So the question was, how much money does it take for foreigners to go another 100 basis points higher? So slightly overweight from their underweight. And the answer is $50 billion US.
Oh God.
Okay. And the problem is that the maximum that they've ever put to work in a single year is 35.
Okay.
So now you are stuck because this is amongst the best performing markets in the world. You're underweight and you're struggling to deliver performance. And to go overweight, the amount of money that you need to put is just not feasible. The market cannot take that much.
So what will your clients ask you at the investor conference which starts tomorrow? Because capital gains might be in focus. You mentioned that your capital market shouldn't be tinkered with. And this is what, the 26th edition of your investor conference?
It is.
Okay, so tell us a bit about the conference.
Yeah, so we have over 300 investors coming in. I think we have about 75 or 80 companies presenting at the summit. We have a few macro sessions as well. I have a special session on deep tech. I am very bullish on deep tech, and I think it's an underappreciated space, and it could be a major growth driver for India into the next few years. India actually has never been renowned for innovation, but what's happening in the deep tech space, I think, will surprise a lot of investors. So that's what's happening. It's a mix of companies from industrials, financials, consumers, energy. I think we have a bit of focus on energy transition because that's a big theme for the next few years. I think aerospace, PLIs, the build out in infrastructure, the overall manufacturing space, I think, remains a big theme. Our view is manufacturing gains share in GDP over the next 10 years, and therefore services will lose a bit of share. Agriculture, I think, retains. So the summit is around this. The main question that is haunting investors abroad, it doesn't bother investors here because we can't put money to work in size elsewhere, right? So until that changes, if we want to buy an equity asset class, then it's only India. For foreigners, the problem is this 21 times Nifty multiple, and they're not able to digest it. Yeah. So there are only two markets in the world that trade at such fancy multiples, the US and India. India trades at this multiple, in my view, for legitimate reasons. You have a strong earnings growth cycle. We're only halfway through. We have strong terminal growth because of our demographics, and our beta to EM is down to 0.3. It used to be 1.3. So the expected rate of return has fallen. So all this means that you're going to trade at higher multiples. In very layman terms, essentially equities are trading closer to bonds than emerging market equities. Okay, because bond cash flows are assured. You know every year you're going to get it, right? So that's how the Indian equity markets are behaving. At some point in time, it will become a bubble. We're not there. We'll get there at some point in time, and that will be the moment to exit the stock market. The economy may still be doing very well, but that may not matter because the markets could have priced in everything. But I don't think it has happened so far. So I think that's one debate. And the second is, I think investors want to get a pulse of how corporate spending will pan out, the question that he asked. So, what are companies saying about their balance sheets? Are they about to start leveraging? Are they about to build big capacities? And I think the third thing will be around macro policy. So some insights into how macro policy will go. Though I think we are probably going to get more momentum behind all the core policies of the outgoing government in this new government. And that message seems to be fairly clear over the last few days.
But let me ask you as we let you go, Ridham. You're very, very bullish on India's future. What are the three things, and we've seen continuity, etc. But if I were to ask you three things that you hope to see, new and improved, but from the same government and the same team in term 3.
Hope.
Yeah, hope to see.
I'm hoping, not expecting. So there's a difference between hope and expectation.
Okay.
I'm hoping that farm laws are brought back to the table. I think for the 200 million farmers in this country, that's going to be the 1991 moment as it was for the industrial sector. And it will ensure that India accelerates on its growth path and becomes a much bigger per capita income than it is today. The farm sector requires urgent reform. So that I think is one I'm hoping, not expecting though. The other thing I think would be, and you have specifically asked for hope, right? Not expectation.
You can add an expect. Two hope and one expect.
No, so expectations are very clear. Expectation, I think we are heading for much lower primary deficit and probably a primary balance in the next 3-4 years. I think we'll continue to see pointed incentives for the manufacturing sector. It will come in many ways. It will come through rationalization of GST. It will come through infrastructure build. It will come through social infrastructure build. It will come through PLIs. It will come through various methods. It will come through greater FDI. So I think those expectations are fairly clear. Another hope I have, which is not necessarily an expectation, is that we should strike a few deals with foreign companies and get them home as quickly as we can. I think we have been a little bit slow on FDI relative to my expectations. So I hope that it can be accelerated. I think the last year or so, maybe there were other things to attend to. But now I think is the moment for us to. There is a vacancy in the world, from the multipolar world and China +1. And I think we can occupy that spot quickly enough. So yeah, maybe these two things.
Two hopes, one expectation.
No, expectations are many. I think I will be right on most of them, and they're all detailed in my report.
Yeah.
In fact, there are so many of them that I lose track of those expectations. Those will all come through.
Okay.
But the couple of hopes that I have, I think the FDI thing will still come through. Farm law, I am not very sure. I think it's a toss-up.
Mr. Musk is excited. Now that all is done and dusted, he's already waiting. But what an absolute pleasure, Ridham. Yeah. Thank you so much.
Yeah, we didn't touch upon one thing. Sorry, do we have a minute?
Of course.
Risk factors. Everybody should be aware. This is not the equities are not a straight line asset class. You don't get up every morning and get a interest, coupon in your bank account. So people should be very conscious of that. I think most of the risk for India are from the world. I think China's deflation is a risk because Indian companies will have to compete with Chinese pricing, which is going to get very competitive and even more competitive. There's a possibility that a renminbi depreciates, which will make it harder for India to compete with China. I think we have to worry about global growth. Unfortunately for India, it does not have the same global growth tailwind that China had when it was doing its jig.
Right.
So India will have to counter a much slower global growth because the world has since then aged and it is also far more indebted than it used to be 20 years ago. So it's not a very pretty world out there. So I think that's the second thing I would worry about. And back home, I think we have, and I expect this, so this is not hope, but I expect it, capacity creation in 4 areas: judiciary, bureaucracy, education and health. Now, education and health are complex because they are, also state subjects. So it has to be, the delivery has to be at the state level. But judiciary and bureaucracy, I think, will occupy a lot of attention in the Prime Minister's office. India has a great contract law, but to enforce it is not easy because the judiciary is, is bursting at the seams. And really, if you want to accelerate from 7% to say 9% growth, that could become an impediment.
Okay. Well, but as the note said, this remains India's decade, and in some sense, it's good to identify risks in a period which is going to be very good for India Inc., Indian markets, and more. So, Ridham, thanks for laying it out for us, and all of us here wish you all the best for your investor conference.
Thank you so much, Niraj. Thank you.
Pleasure having you.